Is CPP, the Canadian Pension Plan, worth it? Are the contributions you make year over year for 20, 30, 40 plus years worth it as far as how much you get out of it? Most of you leave feedback on our channel that says it's not worth it. CPP is a scam. I'm not getting my money back out of it. So I want to take the data, run it into an Excel spreadsheet, formulate it out, and see, is the money that you pay into the Canadian Pension Plan versus what you get out actually worth it? So we're going to break that down in this video. The very first thing we need to do is make an assumption. So what I've done is I've taken someone that turned 65 on January 1st of 2023. So this person had 40 years of maximum contributions. From age 25 to 65, they've made 40 years of maximum contributions. Thus, they're going to get the maximum CPP benefit, which currently is $1,306 on a monthly basis. So as you can see here, this person has paid in the maximum from age 25 onward. So we assume from 18 to 25, they were doing education, whatever it is. They got a good job and they maxed out CPP. Now, again, if you're not maxing out, this will look a little bit different, but the reality is that this is kind of the most extreme case scenario. So you can see in 1983, their maximum contribution, it was based on 1.8%, a bit lower than it is today, and it was $300.60. So that's how much they contributed as an employee. Again, their employer put that same amount in on their side. So we're just looking from an employee standpoint. I'll talk about an employer standpoint here in a minute, but for this employee in 1983, they put in $300. They put in $338 the next year, $379, and so on and so forth. So they put that contribution room in all the way up until 2022. So they maxed out for the full 40 years. So they're, again, going to get that full amount. This person then turns on, starts CPP, and starts collecting $1,306 on a monthly basis. So how much did they put in over time? And how much did it grow to when they started taking it out? Again, CPP is kind of in the background. You don't have control of it. But people think, well, if I didn't pay into CPP and I just took the money and invested it myself, I would be way better off. And before we jump into the numbers, I want to say this. I see it with self-employed people all the time. You can take dividends and not pay into CPP. That is an option for, those of you that are self-employed, run your own business. You could just pay yourself dividends and not a salary. Thus, you will not pay into CPP. The problem with that, and the pushback again with employees saying, I'd do better on my own, is that would you save that money? And again, this is additional money. So from an employee standpoint, like right now, in 2022, you need to put in about $3,500. Would you actually put in $3,500 additionally on top of what you were saving? For most of you, it's not, because most of the self-employed people that we work with that don't pay into CPP have very little savings otherwise. They pumped everything back into the business. And trust me, as an employee, you probably, maybe 10% of you would save that money, but most of you wouldn't. So the CPP is a forced savings plan. That's number one. Now, is it a good investment? Let's look into it. So the first breakdown I did was based on starting payments, again, back in 1983, and we grew it at a rate of return of 5%. So basically that $300 put in, I assumed the money went in at the beginning of the year. I know you make payments, on a monthly basis to CPP. Just to simplify it, I did it at the beginning of the year. Again, going to be a bit more, aggressive and conservative that way. So $300 going in, by the end of the year is worth $315. You take that, add in 1984 payments of $338, times it then by 1.05, 5% rate of return, you get $686. So you can see the column where we're growing that nest egg over time. So again, if you didn't pay into CPP, you took that money, invested it yourself, earned a 5% rate of return. By 2022, the end of 2022, you would have $142,000. So for 40 years, instead of paying into CPP, if you had just invested that same amount of money that you paid into CPP yourself and controlled that investment yourself and average net 5% rate of return on an annual basis, you would see an account value of $142,069. Now, let's take that. Now, you've retired then to 2022, 2023, you're going to start taking money out. If you went through CPP, you would be collecting $1,306 a month. So about $15,678 per year. Now, CPP, as we know, grows with inflation. So I set inflation at 2.5%. Historically, it's been just a hair over to around 2%. I set it at 2.5 here. Again, I'll change it to 2% and show you that as well. But you can see here that we have 142 starting value. We take out 15,678. End of year, we're at 132,710. So basically the 142 minus payment times 1.05, 5% rate of return, we're left with 132. Then from there, we take out $16,070. End of year, we're left with 122. So if we do this process down, increasing CPP payments, which will happen with inflation, and then we take that ending value and roll it into the next year, you can see at age 75, we are basically at $0, meaning that at 76 onward, and again, life expectancy for a 65-year-old individual is 87 years old. So based on a 5% rate of return and a 2.5% inflation rate, you can see that if you were to live till 87, you are $377,000 in the hole if you were to do this on your own. Thus, at a 5% rate of return and a 2.5% inflation rate, CPP is a great investment. Now, if we change that to 2% inflation versus 2.5% inflation, you can see we're down $341,000, so still substantial. Passive is great for passive investors, new or established. If you're managing your own investing, passive is the tool. It allows you to be a better investor. You'll be more organized, make good investment decisions, and feel more confident in your portfolio. Passive makes it so easy to connect your entire portfolio from your brokerage, which gives you incredible power over your portfolio. You can manage your portfolio and analyze it as one single piece, which saves you time and gives you the 10,000-foot view of your investment position that you're looking for. Passive notifications give you a feeling of freedom that your portfolio is self-managing while you're doing things more important to you. When the market changes or new cash hits your account, you'll be notified so you can decide what to do. Passive returns so much value in time and money because it eliminates the need for a spreadsheet, which I know many of you are using. So drop those spreadsheets. No more equations, no more calculating what you need to buy or sell and how much. No more logging in to execute those trades one by one. Set a target and have passive do the heavy lifting. All you need to do is execute the necessary trades you want in one click. Passive will change how you look at your assets. If you're considering changes to your portfolio, you can even create model portfolios that will allow you to understand the impact of every move you make before you make them. I've personally used passive for quite some time now for my own personal trading accounts, just monitoring everything in one place. Again, I have stuff in a few different locations, and passive's been great to kind of consolidate everything in one view and keep a great close eye on it. Passive Elite is a bargain at $99 a year. And for a lot of you that are Questrade users, if you're DIY investors, it's absolutely free. But don't worry, if you're not with Questrade, they do have a free account and there's no credit card required at account setup. So thanks so much, Passive, for sponsoring this video. We really do appreciate it. Now, what I want to do here is look at what will happen if we change the rate of return. So up here I have 105. So let's say I have 107%. So I average a 7% rate of return on my money versus 5. You can see the 142 changes to 208,550. So if I go into employee payments again, you have the 208,550 starting point. You're in the hole at age 81. So even with a 7% rate of return on your investment over 40 years, compounding over time, you're still left with a shortfall at age 81 with CPP. So if we go back to that and look at this again, you're going to see that if I change this to 108, it's going to be closer to a break even. 108, that's an 8% rate of return every single year on average. We get 255,000 at the end of the day. And if we put the 255 in, we're shortfalling at about age 85, 86 there. So you can see that you have to get a pretty good rate of return to equate to what CPP is giving you. So is CPP a good investment? I would say yes, based on its guaranteed rate of return is really good. And B, it's a forced savings plan. And trust me, I deal with retirees day in and day out. Most of you will need your CPP payment, whether it's $500, $800, or $1,300 a month. That CPP payment is a big part of your retirement plan. And again, there's ways to maximize it, delaying it till 70. I'm not going to cover that off in this video. But is CPP a good investment? Well, based on this data, you have to get about an 8 or 9% rate of return net in order for it to kind of equal investing on your own. That's a pretty good rate of return. Now, a lot of you would say, no, Adam, I've got 15% and all that. Most of you haven't. You know, I see and talk to Canadians day in and day out, most of you are averaging around 5% rate of return. That is the most common that I see come into our office that are being managed by a big bank or financial institution. That's your average rate of return. Now, some of you are doing much better. Some of you are doing worse. So I think a 5 or 6% rate of return would be probably average for most of you. And again, when we run a shortfall pretty early in life, giving CPP kind of the leg up on, yes, it's a good investment for all of you. The other thing I don't take into consideration here, and again, I wanted to simplify this for you, is that kind of like a Monte Carlo theory where, well, what happens if we have a really bad return in the last year before retirement? And that's true. Like, what happens in 2022, you go to retire in 2023 and your investment didn't make 5%, it lost 15 or 10%. Now you're in a really bad situation. Again, the Canadian pension plan kind of takes market risk out of it, right? It's a number, it's protected to inflation, it grows over time. It's not tied to stock markets. And as you hit retirement, I can tell you firsthand that removing your investments away from volatile stock markets is a good hedge. It's gotta be a piece of the pie. And that's where old age security and CPP are such a great income source for you in retirement because they're steady, they're guaranteed, and they grow with inflation. Whereas your investments, that's not necessarily the case. Hopefully they're getting a good return, they're consistent and all that, and long term they will do well for you, but there's a bit more fluctuation. Now, for those of you that are employers, this is myself. I pay both the employee and the employer portion, and it's double what the employee pays. So it's a lot of money. And is it worth it? The break even obviously is a little bit different. I won't break it all down in this video, but if I put in a 5% rate of return on an employer contribution, so again, much more, double the amount, at 5%, we're left with $284,000 over that same 40-year period. And if I jump into kind of the employer payment side, the break even's about 87, 88. And again, that's on a 5% rate of return. Now, I look at it from my side saying, is it worth it? Could I get a bit better rate of return over time managing this money myself? Yeah, I probably could. And historically, the portfolio manager that we use has done that for us. But it's an alternative asset. It's protected against inflation. It's a piece of the pie. So again, when I look at my retirement plan, I look at my RSP, TFSA, my wife's accounts, non-registered accounts, our business, commercial real estate that we now own, and CPP and OAS. So CPP is a piece of the pie. I don't mind paying into it. Even as the employer, I'm paying double, but it's a part of the pie. It's a piece of the pie. It's structured differently. It's kind of that guaranteed set and forget it, a decent rate of return. It's basically 5%. If I live to life expectancy, I'm getting about a 5% rate of return on my CPP number, which a lot of you right now are getting 5% on your GICs and your savings accounts, and you're just licking your chops. But when I tell you 5% on CPP, you're like, that's not very good. This is guaranteed. This is like a 5% GIC for 40 years. A lot of you would love that. So I think we need to kind of change the mindset and dig into is this good for me? I know for me, I would say yes. You need to answer that for yourself.